Could the way you save for retirement literally be about to undergo its biggest shift in decades? Welcome to this Strategic Explainer. Today, we're putting on our financial advisor hats to objectively evaluate a rapidly shifting retirement landscape. Recently, an executive order was signed that proposes some massive changes to how millions of Americans save for their future, specifically introducing what's being called the Trump IRA, alongside a pretty controversial push to allow alternative investments into standard 401ks. So let's dive right in, separate the headline hype from the actual financial math, and see what this really means for your portfolio. Here's our agenda for today's explainer. We're going to start with the new retirement landscape, then we'll go inside the Trump IRA, evaluate private equity risks, compare tax-free versus traditional growth, and wrap it all up with your strategic action plan.
Section 1. The new retirement landscape. To understand the solution being proposed, we first need to look at the massive gap in our current system.
Right now, more than 56 million Americans are completely without access to employer-sponsored retirement plans. I mean, think about it. If you've ever driven for Uber, freelanced to design project, or maybe run a small bakery, you know exactly how frustrating it is to not have a 401k match. We're talking about gig workers, solo entrepreneurs, and employees at small businesses that simply don't offer a traditional 401k. For these folks, contributing pre-tax dollars automatically from a paycheck, it just isn't an option. They're essentially left out of the most streamlined wealth-building system in the entire country. And this systemic gap is exactly the problem this new executive order is attempting to solve. Section 2. Inside the Trump IRA. Let's look at the actual mechanics of the new executive order aimed at fixing this gap.
So the proposed platform is basically designed to be a standardized, government-backed portal. Its job is connecting everyday workers with vetted private sector IRAs, and vetted is absolutely the key word there. The executive order itself was signed back on April 30th, and the website, TrumpIRA.gov, is currently scheduled to go live on January 1, 2027. Then, if you meet the requirements, the highly publicized government match would show up in 2028, right after you file your 2027 tax returns. It's essentially designed as a one-stop shop to list, compare, and select financial products without having to navigate thousands of confusing options all by yourself.
Now, a really massive benefit of this proposed portal is the strict mandate capping total fund fees at 0.15% or less. As an advisor, I literally cannot stress enough how important this is. Many standard employer-sponsored 401k plans are kind of notorious for packing in atrocious funds that can charge anywhere from 0.2% to a staggering 5% a year in hidden fees. No way, right? While 0.15% is slightly higher than rock-bottom index ETFs, standardizing low-cost funds for first-time investors is a huge win that keeps a lot more of your compounding interest right in your own pocket. But the real headline feature here is the Savers Match. This essentially offers a guaranteed 50% return on a $2,000 investment, and that's before your money even hits the market. Think about that for a second. If you manage to put in $2,000, the federal government will deposit up to $1,000 into your qualifying retirement account. From a pure numbers perspective, finding a guaranteed 50% yield anywhere in the financial world is, well, it's virtually impossible. However, as your advisor, I've got to highlight that the income limits to receive this free money are incredibly strict. A single filer only gets the full $1,000 match if they make $20,500 or less. By the time you hit $35,500, the benefit completely vanishes. For married couples, the full match stops at $41,000 in household income. And the tough reality here is someone making $20,000 a year is likely living paycheck to paycheck, which makes it incredibly difficult to find a spare $2,000 to invest in the first place just to claim this match. Section 3. Evaluating private equity risks. Now we need to pivot to the second major change, opening up traditional 401ks to alternative investments. The stated goal here is all about democratizing investing. The idea is to give the average worker access to the exact same high-yield, professionally managed deals used by billionaires, endowments, and massive pension funds. Historically, as you probably know, 401ks have been pretty strictly limited to standard public market funds, like an S&P 500 index. But this new directive could allow alternative assets. We're talking private equity, which means buying stakes in unlisted private companies, private credit, where you're acting as a non-bank lender, and even digital assets like crypto, right into your standard plan. In theory, this offers higher returns and broader diversification. But, and this is a big but, this introduces massive liability. This was highlighted by a pretty stark warning from the Department of Labor regarding employers who actually offer these complex assets. As an advisor, this is where the red flashing lights go off. Employers have a fiduciary duty to make sure the funds they offer are relatively safe and vetted. If a company opens their 401k to highly speculative private investments and their employees end up losing their life savings, well, the employer can be, and absolutely has been, sued into oblivion. So the absolutely crucial point here is understanding what you're actually buying. Unlike transparent public index funds, where you can just log in and see exactly what you own and what it's worth every single minute of the day, private investments carry severe risks. First off, they're incredibly hard to value. They are highly illiquid, meaning your money might be locked up for years or even decades. And they come with significantly higher, sometimes exorbitant fee structures. On top of that, these private assets can sometimes be quietly packaged into seemingly safe target date funds. Critics rightly point out that injecting private equity into 401ks could easily become a massive payday for Wall Street managers at the direct expense of everyday retirees who end up taking on all those hidden risks. Section 4. Tax-free versus traditional growth. Setting aside the new policy for a moment, let's conduct a comparative analysis on the most powerful tool you already have, tax planning. All right, grab your calculators because this is where the real wealth is built. We're going to run the numbers on a decades-long projection just to see how tax structures critically impact your final wealth. Let's assume you start consistently investing at age 20 and carry that discipline all the way to age 65. If you're young or in a low tax bracket, you really have to weigh the upfront tax savings of a traditional 401k against the back-end benefits of a Roth account. It's like a scale. A traditional 401k uses pre-tax dollars, lowering your tax bill today, but then you pay ordinary income tax on every single dollar you withdraw in retirement. A Roth IRA, on the other hand, uses after-tax dollars. You pay your taxes today, but every cent of growth compounds completely tax-free for the rest of your life. Let's look at the actual long-term growth potential here. Say you invest $7,500 after tax into a Roth IRA every year. By age 65, you've got roughly $2.5 million completely tax-free. Over $2 million of that is pure profit, completely untouched by the IRS. Now compare that to a traditional 401k. Because of your upfront tax savings, you could afford to invest a higher gross amount, let's say $9,400 a year. That grows to a really impressive $3 million. However, the math shows that owing ordinary income tax on those massive profits in retirement often makes the $2.5 million tax-free Roth IRA the strategically superior choice. I mean, keeping 100% of your gains without worrying about future tax brackets, that is an incredible advantage. Section 5. Your strategic action plan. Based on all the data in this explainer, let's summarize your strategic action plan. Let's bring it all together and go through our checklist to see how this builds your wealth strategy. If you make under $35,000 single or $71,000 married, and you can scrape together $2,000, absolutely take advantage of the Trump IRA's 50% government match when it rolls out. It's literally free money. Actually, scratch that, it's government matched money, but you get the idea. However, if you're young, in a lower tax bracket, and don't qualify for the match, opening a standard Roth IRA on your own right now remains arguably the sharpest financial move for tax-free compounding. If your 401k eventually does offer private equity, proceed with extreme caution. Only deploy capital there if you have a high risk tolerance and fully understand the fees and illiquidity. And finally, if you don't qualify for the match, remember that a standard taxable brokerage account still offers 0% capital gains tax if your income stays under certain federal limits. Ultimately, these new policy proposals are a fascinating entry point for low-income gig workers who just need a simple place to start. But for many others, they introduce some potentially dangerous complexities. As Wall Street continues pushing to get their alternative assets into your retirement accounts, ask yourself this: are you truly prioritizing the right investment vehicle for your financial future? And is this new landscape designed to build your wealth or theirs? Stay sharp, carefully evaluate the risks of what you own, and as always, let the math lead the way.